Hello and welcome to today's video, which is called S&P 500 Breakout. Breakout because stocks did break above the key resistance of 4415 and it happened reasonably fast within one day, Friday, just following the Treasury's auction setback. So make sure that you are subscribed on my site because you have probably noticed that the daily articles have expanded in volume and in chart content, so premium subscribers are getting more and upgraded content, and I'm relatively less on Twitter, but I still answer, and the line has been drawn towards clients that get most of my time. So make sure that you are subscribed even for free analysis whenever a new post goes up, and as well to this channel that seeks to prepare you for the week ahead. So let's dive into the big picture. The Treasury's auction, and it was this and not Powell's reiteration of not being sure whether the Fed is done hiking Thursday, that was the driver, as much as the ransomware attack at the biggest Chinese bank, by the way, a key treasury markets participant, that facilitated the selling across the board when the Treasury's 30-year auction results had been announced. Even if Powell was relatively hawkish in its delivery, you can see that rates had been having trouble rising too much, especially the long end was lagging, because it correctly appreciates that we are in the latter innings of Goldilocks, and that inflation is turning sticky. Moreover, this realization across the mainstream would be hitting home in the following months. We are not there quite yet. For now, we had seen both a revival in in soft landing trades, which was exactly what I told you the week before in this video, and the short end of the curve featuring sporting higher yields than the long end. In other words, bond markets have put an end to the steepening of the yield curve, and they tend to believe that the Fed would be able to remain higher for longer and restrictive, no matter what financial conditions are doing. You can see that Nasdaq is ignoring the rise in short-term yields, and it's actually the key driver of the stock market upswing, which is very positive. And as well, in the premium section of tomorrow's analysis, I'm highlighting which sectors are leading and what does it mean, what it means for the upcoming S&P 500 price path. Certainly, the scare of this weekend is Moody's outlook downgrade. Fears are that it would take stocks lower, and that this, if there is bearish gap, that it would not get closed for quite a while. Would it trigger a deep correction? How different is this from the summer downgrade? Well, I guess we will see the resolution pretty fast, and I'm as well talking that in the premium section of tomorrow's article. the big picture theme is that we are seeing the conflict between that reigning Goldilocks and the arrival of sticky inflation. And when the growth rate starts decelerating, because frankly the GDP of late had been way too much reflective of fiscal dominance and positive inventories build up, we would start hearing the word stagflation significantly more, but that's the music for the upcoming year. For now, we are seeing inflation expectations at the consumer level going up, and as well the Fed's favored inflation measure, whether PPI or CPI, but in its super core version, to be leading towards the stagflationary outcome. And as said on the final line, which is really important to hammer once again, markets think that the Fed would be able to remain higher for longer, therefore the short end of the curve went up and remained up throughout Friday as well, and that bodes well for US dollar, which may have seen the corrective bottom that I had called probably 2 weeks before as likely to be on the immediate horizon. So let's dive into this stock market chart. You can see how easily 4415 had been overcome, especially if you look at the hourly chart, which is what we have been commenting quite often on the intraday channel. This break happened in one day. Have a look at how well tech had been doing, and as well the already discussed sectoral perspectives and what that means when stocks closed this well. Is it well? How about the percentage of stocks trading above 50-day moving average? Or what about the advanced decline line making a lower high? Is this still okay? What about junk corporate bonds, another lower high? Is this still okay? I'm saving these comments in the premium section of tomorrow's analysis. And let's move into gold and silver, where I had been later on Tuesday highlighting the decline as offering a nice rebound opportunity, and when it had been starting to roll over back to the downside, I cautioned about easy break of those lows. Easy, potentially very easy, and it's turned out so. We had a nice reversal Thursday following the botched treasuries auction that did not live up to expectations at all, and now we are at the washout level, which is corresponding to the high 1930s, which was the premium level that I gave on Friday to trading signals clients. So you have a multitude of options of what premium services to join and to benefit in your own trading, depending on the markets that you do trade, whether it's swing or intraday. So I'm pretty sure you are familiar with my journey and profile and all the public announcements that I have made over the prior couple of years, and the obligatory disclaimer and best wishes for the remainder of this weekend. Thank you and have a nice Saturday.